I don't think there's actually going to be a great deal of change in the monetary policy outlook over the next couple of years. I think that the current historically low levels of policy rates are probably going to endure throughout 2017 and into 2018. We're in an environment of pretty modest growth, inflation which is tending, if anything, to undershoot the targets of the major central banks. And also we're in an environment where I think there's a lot of caution on the part of policymakers. They really do not want to go back into the sort of deflationary hole that they found themselves 7 or 8 years ago. So the bias in monetary policy will be towards laxity, towards accommodation, rather than there being in any great hurry to push interest rates higher. I think the Fed's desire is to continue to push interest rates gradually back towards what they used to consider to be normal levels. The question is whether the international environment and other aspects of the domestic policy environment will allow them to do that. What we've seen over the last few years is that when a central bank has pushed its policy rates up, its currency has tended to appreciate. And that in turn has then intervened to slow that pace of monetary normalization down. What we can see in the US at the moment is that it really is the only major central bank with the desire to tighten policy. All the others are quite happy to keep rates more or less where they are. And in that kind of environment, we could be facing a sudden surge in the dollar. And I think that would stop the Fed in its tracks. The other consideration which may intervene is what are the prospects for fiscal policy? What are the prospects for deregulation? Were the Trump administration to deliver on its tax reform promises, were the Trump administration to deliver on its deregulation promises, you could see economic growth suddenly pick up. And in that environment, I think the Fed would come under pressure to accelerate the pace of monetary tightening, simply because that sort of combination of all-round stimulus would probably add to inflationary pressures to such an extent that the Fed would feel that it had to intervene. It had to step in and accelerate those rate hikes. Frankly, I think the ECB is likely to remain on hold for another extended period. We may well see some tensions developing within the Governing Council between the Bundesbank and many of the other central banks. But overall, I think Mr. Draghi will do his very best to keep things more or less as they are. The ECB has been in an environment of very low inflation, operating in an environment of very low inflation for many years now. It will be cognizant of what that might do to inflation expectations. It will want to really make sure that the economy has reached critical mass and is growing above potential. It will want to make sure that inflation is coming back to target finally before it really begins to unwind the unorthodox policy measures that it currently has in place. So I would be very surprised whether to be any change in the way the central bank manages its balance sheet, or for that matter the way it manages policy rates during the course of this year, and it may actually be some way into next year before they begin that process. I think for the moment at least, the Bank of England's desire will be to stay on hold. The increase in the inflation rate, the headline inflation rate, what we're seeing in the UK at the moment, is largely the result of a one-off shock to the price level. And that in turn was the result of the depreciation of sterling last year. My sense is that as long as the wage environment remains relatively quiescent, as long as inflation expectations remain pretty much under control as they appear to be at the moment, the Bank of England will be quite happy to look through this period of above target inflation and keep policy more or less where it is. Key considerations to watch for: very much what's happening in the labour market. Were the labour market suddenly to throw up much faster rates of increases in wages, I think the bank could be encouraged to move more precipitously. Another consideration that could intervene would be a further depreciation of sterling, let's say in the context of uncertainty over the Brexit negotiations. But notwithstanding these considerations, my sense right now is that the bank will probably stay on hold throughout the course of this year and perhaps some way into next. The Bank of Japan is in an extraordinary place in terms of macroeconomic policy or monetary policy. We have had what is now essentially a lost generation of economic activity in Japan. We've had an inflation rate which has been stubbornly reluctant to rise much above zero. Yet we have this extraordinarily expansionary policy, rapidly inflating balance sheet, reaching levels which are more or less unheard of in advanced economies, negative policy interest rates. Yet it still seems that the BOJ is a long, long way from starting any process of normalization. The inflation rate is not going to get close to the bank's target, its 2% target, I think probably until something like 2019, 2020. So I'd be very surprised if interest rate policy changes in Japan for the foreseeable future. One possible area of change could be the amount of bonds that the BOJ buys, but that may be simply down to the fact that they're running out of bonds to buy more than anything else. So the BOJ is going to remain, I think, in this rather remarkable situation of keeping policy rates negative, continuing to expand its balance sheet at a rate which is truly remarkable. Abenomics is not going away anytime soon. China's problem is one of excessive credit growth and the sense that it can't really grow at the rate which is necessary to achieve social and political stability without the government and the central bank presiding over a very rapid expansion rate of credit. This puts the authorities in something of a catch-22 situation. Right now they are, I believe, trying to tighten monetary conditions, trying to take some of the froth out of the economy. Whether they can be successful in that, I think, remains open to question. What we know from history is that periods when you have rates of credit growth well in excess of the rate of growth of the underlying economy, this tends to end in tears. A lot of people believe that China's in a position where it could be the exception to that rule. I'm a little bit more cynical. I think at some stage there will have to be some sort of adjustment, if not some sort of trauma in China, simply because the rate of growth of credit will have to be slowed down and slowed down significantly. And it's very difficult to believe that the economy would not respond badly to that kind of policy prescription. And if the economy responds badly, well then I think all the underlying social tensions which are there in China could rapidly rise to the surface. It could make for some very challenging policy decisions where the People's Bank and where the Chinese government more broadly is concerned. I'd probably shout and scream a great deal, I would imagine. My sense is that he's not going to get everything he wants. My sense is that it's going to be difficult to push his reforms through Congress, even though he has a considerable majority of Republicans there. My sense is that equally his proposals on deregulation may well run into some trouble as well. So overall, my sense is that policy in the United States will not be anything like as expansionary as Mr. Trump would like it to be. And actually that may be a good thing. If you look at the US economy right now, it's close to full employment. The inflation rate is gradually converging with target. The economic growth rate, the underlying economic growth rate is pretty close to potential. There really isn't a case for any major stimulus, fiscal or whatever. And so if Mr. Trump's ideas don't actually come to full fruition, I think that might actually be something which encourages greater stability for the US economy than we would see otherwise. I think one consideration we have to bear in mind in looking at the outlook for monetary policy and economic policy in general is the fact that this business cycle is already relatively long in the tooth. We are some 8 years into the expansionary phase. And what that suggests is, at least on the basis of historical precedent, is that a recession is not going to be too far around the corner. Perhaps within the next 2 or 3 years, we could well experience another downturn. And over the course of that 2 or 3 years, it's highly unlikely in my mind that policy rates in any of the major economies will rise significantly above the zero bound. Now, what normally happens in any major downturn is that the central banks actually slash their policy rates by anything between 300 basis points and 600 basis points. It is very, very difficult to believe that any central bank will have that kind of orthodox monetary ammunition in its toolkit when the downturn arrives. What that means is that the sort of unorthodox initiative, quantitative easing, credit easing, forward guidance, negative interest rates, all of these considerations that central banks have relied upon over the last 7 or 8 years will have to either remain in place or be reinstated relatively quickly when that downturn appears. We are not going to escape the current unconventional environment for monetary policy. In fact, in many ways, the unconventional is likely to become the conventional. I think the Fed's abandonment of balance sheet manipulation is likely to be very slow and only partial. There are some very good reasons why the Fed should keep its balance sheet considerably larger than was the case before the global financial crisis. These range from the fact that the banking sector or the financial sector would benefit from greater levels of liquidity, to the fact that the current tools that the central bank in the US is employing to control interest rates are actually working very well, and also the fact that, generally speaking, the US economy is actually growing into this expanded balance sheet that the Federal Reserve currently has. So I'd be very surprised if we go back to the sort of minimalist balance sheet which we saw prior to 2007. Probably we'll see some degree of contraction from current levels, but not dramatically so. In the interim, there's likely to be, I think, considerable debate across the FOMC as to what precisely is the most appropriate size of that balance sheet. But one thing is for sure, we don't go back to where we were. The status quo ante, if you like, will not be revisited.